Hi, welcome to the latest Facts versus Feelings, Take 5. Sonu, we're going to call this one, Will China's Economic Troubles Hurt Us? We've heard a lot about China slowing down. And the issue is, do they own a lot of our debt, Sonu? Could they sell our debt? Could they hurt us? There's a lot of ways we want to go with this discussion. But let's just start high level. How much is China's economy really slowing down right now?
Look, they're in big trouble, right? If you just take consumption in China, retail sales, for example, are up 2.5% year over year as of July. That's before the pandemic. It was running at an average pace 7 to 10%. Usually, the industrial side is what makes up for the lack of consumption, right? But not this time. Industrial production just up over 3.5% over the past year. Again, before the pandemic, that was running about 6%, right? And so economic growth in the second largest economy in the world is now set to slow meaningfully. You take, between 2000 and 2011, the Chinese economy grew about 10%. From 2012 to 2019, it grew an average of 7% per year. That slowed to about 4% over the last 3 years. And it looks like growth's likely to slow even further, maybe to 3 to 3.5%.
And that's one of the more interesting things, I think, because you look at the United States, we talked about this before, but our growth is really accelerating the last couple of months. And we wouldn't be surprised at all if going out the next several quarters, the United States actually has more economic growth than our friends in China do, because, again, that'd be pretty rare. That you don't tend to see that. So, Sonu, that's the big question. The second largest economy in the world is really starting to have some trouble. We're not yet. The United States economy is still strong. But do you think that's going to spread and really hurt the United States?
Short answer, no. Look, the reality is it's amazing to think that the U.S. economy is going to grow faster than the Chinese economy.
Yes, it is.
At least this year, right? But the U.S. economy is mostly dependent on consumption. You and I have talked about that in the past. Just under 70% is made up of consumption. In China, that's not the case. It's under 40%. It's a supply side that matters more. It's driven by investment spending that accounts for just under 45% of GDP. In the US, that's 20%, right? A lot of this investment spending goes to real estate, right? And that's on the back of rising debt. Overall debt in China to the private sector, non-financial sector, as they call it, that was 140% of GDP at the end of 2008. Now it's about close to 300%, Ryan.
Wow.
So contrast that to the US, where it stayed steady around 250% of GDP. Over the last decade, it's not really grown, right? So that was, China grew after the financial crisis on the back of debt and a lot of investment spending on real estate, but a lot of exports too, right? And you think about, how are they going to grow in the, going forward? They don't want to take on a lot of debt because there's a lot of unproductive investments, bridges, highways to nowhere, things like that, airports that are not filled, residential apartments that are, a fifth of residential apartments in China are apparently empty, right? So they're building a lot, nobody's using it. And that's not the case in the US. The problem is consumption is not prioritized in China. And the government in China doesn't want to send them like checks like the US government did during the pandemic, right? And then even safety net programs like Social Security, Medicare, you don't have the equivalent of that in China, at least to not that extent. So the savings rate in China is a lot. The Chinese households save about 30 to 35% of their income, which is massive. In the US, that's about 5%, right? That's because we've got a social safety net that they don't, right? So they've got to save a lot. And so there's not a lot of consumption coming. Investment is going down because they're worried about bad debt. And in terms of exports, that's the only way they can grow. But what does that mean? That means they're more dependent on Western demand, especially US demand, than I would say we are dependent on them, right? In fact, US imports from China have been falling over the past year. Right now, imports in China as a percent of GDP, it's less than 2% of GDP. That's the lowest since 2006. Now, imports from everywhere else have picked up. And look, the reality is trade with China is not going to zero, but it's going to get, relatively smaller as we see this decoupling sort of happen. Like US companies are going to countries like Vietnam, Philippines, India, and that's where a lot of imported goods are getting rerouted through instead of going through China and coming to the US, right? So like I said, the reality is that China needs the US more than the other way around.
Yeah, well, that was a pretty thorough answer right there. You think about it. So the U.S., if you look at something like the credit markets, keep this real simple. The credit markets are functioning just fine. We are not seeing stress that some of the lower graded companies out there will not be able to pay back their debt. If we were, we'd be seeing spreads blown out. We're simply not seeing that. Also, when you think about it from the U.S. point of view, we're not importing nearly as much from China, as you just mentioned, Sonu, as we once were. So that's a positive. Also, back in 2014, China held over 20% of all the foreign debt out there, of U.S. debt. That's the most of any foreign country. Now they're down to about 11%. Japan actually holds the most foreign debt, most U.S. debt out there out of all foreign countries. So again, the worry that China could just sell our treasuries to really kind of hurt us, it's not really there. It's not really there like it once was. So with that, we're going to have to wrap up this week's Take 5. China's in the news. They are slowing down, but we do not think it's going to hurt the United States. Take care, everybody.